just to recap what we did last week, we sort of, because we've got very limited time, instead of going through the share purchase agreement and shareholders agreement altogether in two separate transactions, I wanted to do just one, the joint venture agreement. And I need to tell you what the differences of those two are. If you create joint venture by establishing a new company, for example, right? Then obviously you can skip a whole lot of process of trying to figure out the value of the company that you are investing. That requires a whole lot of due diligence, both legal and financial and business. And that requires a lot of time and cost too. You have to hire your PwCs at Deloitte, and and you need to hire Shin and Kim or Kim and Chang or Lee and Co or Baek Kim and Lee or whatever, right? And then then you need to go through valuation. You have long hours of negotiation, perhaps in the share purchase agreement. And a lot of those negotiation concentrate on reps and warranties, right? So I have explained to you the purpose of representations and warranties. That significant part of a share purchase agreement in existing company, because those reps are necessary, because you make the valuation based on certain assumptions. Assumptions meaning that whatever documents and information you have provided to me, based on that information contained in those things, I am making my valuation of the company. And we have negotiated, agreed on the price. But what that basic assumption is, the company has no other unknown, undisclosed liabilities of any kind. Everything that you have disclosed to me are basically a true and correct, right, in material respect, right? Your financial data that you have disclosed to me, the financial statement, audited financial statement, are basically, in accordance with GAAP. That's why they ask for audited, because then you understand that those auditors go through the basic steps of verifying the various information. They just don't take the accounting information that is given by the company for granted. They go through the verification stage, and they are experts in that stage. Anyway, so basically that's what they're saying. So every chunk of the business, every different aspect that consists of the business, for example, your assets, your equipment, machinery, or whatever. Then if you got real estate, your real estate is, you have the title, valid title of the real estate, and all that kind of things, right? And you got intellectual property, right? Because who knows, you've been using intellectual property for so long, but one day, you wake up and find out that somebody has sued for, infringement, right? You have known that the company called Korong has a very big lawsuit in the United States where they lost the first, lower cost decision that cost billions of dollars, for them. If you get one of those decisions against you, your company is in a lot of trouble. So that's the reason, right? So you make those reps and warranties regarding intellectual property litigation. We expect that the list of litigation that you have disclosed to me and the information regarding that litigation and the exposures are based on what you have disclosed, and there is no other thing. You are not currently threatened, for example, that somebody is asking you to sue threatening you to sue if you do not, do whatever I tell you. All the contracts that you have are in order, and they will not be, they will not be terminated just because of my investment or things of that nature, right? So they just want to make sure, and that's why those reps and warranties are very necessary, because based on those representation and warranties, in reliance of that representations and warranties, okay, I agree to purchase. So once the transaction closes, right, and you get the share and you give the purchase price, and if something happens, you find out within certain time, usually what they ask is full fiscal cycle, okay? That's the minimum that usually investors ask, because you need at least a full fiscal cycle to see what's going on, See whether the information you have provided is anything strange or missing. So, for example, if the transaction closed in June, and the fiscal year starts from January 1st to December 31st, right? Then they would ask one full cycle. Since we are beginning in the middle, at least I want to see one full fiscal cycle, okay? So 1.5 years. That translates into 1.5 years, okay? So that reps and warranties will survive at least for 1.5 years. If I find anything wrong within those periods, then you have to indemnify, right? Before the time of signing and closing, right? If it is known to me that some representation and warranties are being breached, that is not true, okay? You have that seller actually is breaching, you have known, then you have right not to close, not to proceed, okay? But once you proceed to close, then you cannot unwind the whole thing, right? Because that purchase price might be gone somewhere, right? So the only way that you can you can deal with this would be, instead of unwinding, it would be through indemnification. So you need, accompanying a long section of indemnification, accompanying the representations and warranties section, right? So I have explained why those sections are there, and then why those indemnifications are necessarily be longer, because there's nothing really to indemnify or hide, because from the beginning it is co-managed. You appoint, the investor appoints, and this investor appoint, they create, and if it's a 50-50 joint venture, then you appoint the equal number of directors, and they begin to manage from the beginning, right? It's not under someone else's control for a long time. So that is the reason why we have all those sections. And then there's another section that deals with the covenant. And one aspect of covenant, I think important chunk of the covenant, is to prevent, okay, from the date of the signing until the closing of the transaction. Basically, this guy has a vested, the investor now has a purchaser now has a vested interest in this company, because I agreed to close when the certain closing conditions are met. And one of those closing conditions are the representations and warranties are true on the closing date, right? So you now have a vested interest that you cannot let this guy just control and do the thing, because now it's going to be joint control. If under joint control, if material decisions are made jointly, right, then in between those periods, you either do not make any material decisions, or if you need to make material decision, at least you need my consent, right? So you have all these sections that needs to cover part of those joint venture shareholder mechanisms that needs to be covered during that period. So basically, these are the big chunk of a in any type of investment into existing, right, existing company. So I tried to explain a little bit about that, but now we come back to our main theme. All right, so previously we have gone through the first part about the foreign investment and your general concern and where you get the relevant information. Now we want to talk about the legal entity and corporate governance, right? So let's look at number 2. What will be the legal entity for the proposed joint venture, right? What are some of the kind of types of legal entities that you can think about? Can a legal entity be partnership? I mean, law firms are like partnership, right? Yeah, it could be partnership, but rarely is. Why? What is the main difference between partnership and creating other type of legal companies like 주식회사, which is a joint stock company, or 유한회사, which is a limited liability company, and 유한 책임회사 now we have, right? Which is literally limited liability company, right? So what is the difference between 합자 한 명 and that, right? Partnership. So there's that basic distinction between those two types of entities. One is limited liability, and the other is unlimited liability. Okay? So limited liability means I can limit the liability, my liabilities, okay, to whatever that I have invested in that company, right? Whatever that I have put in as my capital, you know. Or if I lend money, I can lend money, okay? But anyway, that's my liabilities. And I have no more liabilities than that. Okay? Unlimited liability situation, they can come after you and start doing your assets, you know, whatever that you have, right? So in partnership, that's why usually the partnerships are usually for individuals, right? And like us, like lawyers, do the partnership. Why? Because you know, when you are talking about partnership, then partnership, how it operates and managed, it's managed by the partners, right? And in partnership, the partners manage, and therefore they have responsibilities, right? Since they manage, and they take whatever profits that they're generated, so therefore they have joint responsibilities for profit management and liabilities as well. That's why partnership, there's a very careful selection of who you want to partner with. You go through this period of evaluation that they don't just take anybody partner, but has to demonstrate that that person is suitable to be a partner, right? So there is the whole list of distinction between those two. So usually it's a company they want to create. They don't want to expose themselves more liabilities than what you put in, right? So in that sense, then you have, if you're a profit generating entity, you only have 3 choices. Those choices are either 주식회사, joint stock company, 유한회사, or 유한 책임회사. Okay? Only 3. So here are basically some of the distinctions that, you know, distinguishes between these 3 types of companies. Basically, all of them are limited liability features. Okay, all of them are limited liability features. If you move toward 주식회사 to 유한 책임회사 toward the right, obviously you have a lot more flexibilities in management. But together, the flexibility comes with certain things, right? Yeah, sure. 주식회사 requires more formal things like you definitely need to have a board of directors, but you need to have directors, right? If you what is that monetary threshold? What's the required number under Korean Commercial Code? How many directors are you required to have under Korean Commercial Code? If you are a joint stock company, 주식회사. Guys, it's gonna come. That's a question that will come out in the bar exam. You cannot possibly say I don't know. Okay, that one will come out in the bar exam. So it's 3, right? Minimum number of required directors is 3 for 주식회사, but there is an exception, right? If your total paid-in capital is 1 billion Korean won or less, is it 1 billion Korean won or less than 1 billion won? Korean won? Okay? Yeah. So if it's 1 billion Korean won or more, okay, your total paid, you must have 3. But if it's less than 1 billion Korean won, 10억, right? Then you can have 2 or 1 director. If you only have 1 director, that director will also be the representative director, right? So there is that whole system, okay, of board of directors and what the board needs to do and what the shareholders need to do. The Korean Commercial Code gives you a lot of kind of mandatory statutory requirements for that. But if you move toward to 유한 회사 to 유한 책임 회사, as you can see, the directors, no directors is needed. Okay, number of directors not applicable. Board of directors, no. Statutory auditor, 감사. Do you need statutory auditor? No. Statutory auditors, how many statutory auditors do you need for a 주식회사? 1. Unless you are a small company with paid-in capital of less than $1 billion, 1 billion Korean won. All right. So for smaller companies, for example, you don't wanna like appoint statutory auditor. You probably don't want to appoint too many directors, because then you need to have the board of directors meeting. That means you need to, in order to convene a board meeting, you have to give notice, right? There's a statutory required period for convening a shareholders meeting. You have to give at least 2 weeks, okay, notice. You cannot shorten that. You can probably make it longer, but you cannot shorten that period. So from that kind of administrative things, 주식회사 is more difficult. However, if you want a kind of large-scale business, your preference would be a 주식회사. The reason being that you have all these systems and you have all this court precedent that kind of gives you a legal certainty of how this functions, right? If you take a look at those commercial, what do you call that? Commentaries, okay? Like legal commentaries for Korean Commercial Code, right? 상법, 주석, you will see that their discussion of 주식회사 is this much, and you have this discussion of 유한회사 a few pages at the end, and then 유한 책임회사 is even less. Meaning, a lot of things are undetermined. If you really dig into what will happen, does 유한회사 is what happens? There's no court cases. You don't know what will happen until it is being tried, right? Anyway, but why is foreign investors sometimes prefer 유한회사, or 유한 책임회사 only came recently, so it has not been tried much. Foreign firms, foreign companies, when they have a wholly owned subsidiary here, right? They would, yeah, if it's wholly owned, you don't need all that trouble of going through and have the board of directors and all of that. So you can have something simpler. And also for 유한회사, if you go over a certain size, you don't need to publish. You don't need to make public your financial statement and things of that sort. If you become a big kind of a company, you need to report, okay, your financials, right? You don't have the requirement for limited liabilities company. That's a big reason. And another reason may be a selection. You can select this under, for example, U.S. companies. You can select this limited liability versus regular corporation. The difference between is like this pass-through mechanism, where those companies. So when there is a company, if you have a limited liability LLC, and you have this is called not a shareholder but a member, okay? Okay. So member can own LLC, and LLC engages in businesses and earns income, right? Then this member can select, for example, in the United States, where this LLC will be taxed here at this level, or just pass through, and he will just pay taxes over here. When you have a corporation, now, right? When it makes income, you have to pay corporate tax, right? You have to pay corporations tax. And then it goes, some of the profit could go to its shareholders as a dividend, in the form of dividend, right? And dividend becomes an income of this shareholder, and you have to pay tax on the dividend too. It's an income, right? So it's a kind of, in a way, it's a double taxation. But here, you only pay tax once, right? You can just pass through, right? This pass-through mechanism, sometimes in tax-wise, is very, maybe it's a notable kind of a feature. And the companies, sometimes the foreign companies under this system wants to create an LLC so that they are recognized under their tax IRS, Internal Revenue Service, that this is a pass-through entity, So for that reason, sometimes they want to do that. But if you want to create a joint venture where you don't have the control, neither, it's 50-50 joint venture, we are assuming, right? Then I think the operation of this entity becomes very important. So unless you have those other needs, the preference would be 주식회사, right? Let's just take a look at it. Information on equity holders required to be incorporated into AOI. Not required. What does that mean? What's AOI? That's Articles of Incorporation. It's 정관, right? For 유한회사, you need to write the name, the resident registration number, or some kind of identification number, address, and how many shares you own. In other words, this is the information that does not go into articles of incorporation for 주식회사, but it goes in here. So every time you gain more here in Korea, you say it's a unit instead of shares. You get more units, articles needs to be amended, right? Every time, because articles needs to be amended. In corporation, you don't have that. It's just a company just keeps a shareholders registry and say, okay, who owns how much shares? And then when these things are changed, this company just keeps it, but there is no reporting requirement for the corporation, right? They don't need to change the article because on here, in order to change the articles of incorporation, which is a fundamental organization document, you need a what kind of decision-making process is required to change the article? Can you change the article with the board of directors resolution?
General Assembly?
Hmm?
Through the General Assembly?
That's right, through a general meeting of shareholders. The directors, board of directors cannot change the articles of incorporation. Okay? The KCC, the Korean Commercial Code, mandates that you have to get a resolution of shareholders at a general meeting of shareholders. Not only just a regular, ordinary resolution, but you need a supermajority, a special resolution. What is a special resolution required under the Korean Commercial Code? Do you know? What's the ordinary resolution? Now these questions will come out in the bar exam. I have a feeling. Okay, so you need to go through your commercial code and basically you need to learn that. Okay. In any case, you need a special resolution to change. So we don't have this, but here those informations are required. Both for limited liability company. Equity certificate. Equity means a ownership, right? Ownership. So equity certificate, it could be a shares, common shares, preferred shares, something that deals with ownership. Okay. So for example, here the 주식회사, if it's common shares, or it could be preferred shares, whatever, but that share certificate could be bearer or non-bearer form, meaning it's, okay? It could be non-bearer, 무기명, or bearer form, 기명, okay? But in 유한회사, only non-bearer certificates may be issued. Okay, so 유한회사, you cannot issue 기명식. Okay. Classes of shares. Many. There could be 2 or more classes of shares. Okay. There are many different types of classes. Common shares, preferred shares. There's within the preferred share there could be different type of preferred shares. There could be many. However, for yuan or for limited liabilities, only one class of units is permitted. Securitization of shares, what it means, let's forget about securitization, but it's allowed, but it's prohibited for yuan회사. Management of business, daily, is done by representative director, and representative director under Korean law cannot be a corporation. It has to be a person. Management can be either director or representative director. And for yuan 책임회사, it's just managing member. Okay. Board of directors, if you look at the close to the bottom, it's required. but 유한회사, it's not, you can have it if you want to, but it's not prescribed by law, it's not required. So what happens if 유한회사, you want to have a board of directors, but all those KCC and the court interpretation of the KCC concerning the duties of the board and duties of, how this functions and all those kind of things, does it apply in case this 유한회사 has a board of directors? It's uncertain. How much of that, there's a lot of cases and rules, okay? In other words, laws regarding board of directors, okay? Their functions and the way that they work and, this and that. But whether the board of directors, that those rules apply also when 유한회사 has the board of directors, we are not sure. Unless someday it's been tried at the court and court says, yes, this one he needs to do that, and or until that time, we live in uncertainties, kind of, right? So obviously if there is, so those kind of things, when you have a dispute between two shareholders in 50-50, it's not very desirable, right? Statutory auditor optional, This is it, okay? Requirements for amending the Ioi. If you take a look at next, you need 2/3 of the voting rights of the shareholders present at the general meeting, plus at least 1/3 of the total issued and outstanding. That's the special resolution that I was talking about. So what is it? If you give a shareholders meeting notice, okay? You convene we're gonna convene a shareholders meeting, so you send a notice. It has to be at least 2 weeks under Korean Commercial Code to all those shareholders. Of course, they can waive it, if everybody agrees to shorten or just, waive it, but unless they do that, you have to give those 2 weeks notice. All right? You cannot shorten this through articles of incorporation. So after those notice, whoever decides to come into the meeting, right? Whoever shareholders, how many shares that they represent, okay? The quorum, meaning that this meeting will be validly held, right? Will be decided later, but anyway, under Korean Commercial Code, whoever is present, you have to get 2/3 of whoever that is present, okay, at this meeting. Right? However, if those 2/3, you get more than 2/3, but if it's still less than 1/3 of your total issued and outstanding shares, if the total number of issued and outstanding shares is 10,000, right? Then you have to have more than 30% of that. Okay? So it will be 33,333 or something like that. Okay? It has to be more than that. It's 2/3. Whoever that passes this has to be more than that. That's the rule. For ordinary, it's the majority of those who are present. It has to be more than 1/4. Okay? You have to memorize this. But 유한회사, they have a different kind of rule. But anyway, if you notice this, public notice of annual balance sheet is required, not required, not required. This is one reason that why foreign companies, if they have especially own, subsidiary where they control, they don't want this data to be out there so that other people can see it, right? You need to give a 공시, your balance sheet, right? lot of companies don't do it. Anyway, but you see, whenever you remember when you guys used to have the newspapers, and at the end of the fiscal year there was this, in the notice section where there's a lot of companies, they kind of give notice of their balance sheet. Do you remember seeing that? And that's where this is coming from. Anyway, so you go through this exercise to select the right type of company that they could incorporate, right? So what will be the legal entity? Will it be a limited liability company or joint stock company? What are the general factors to be considered by the investors in deciding on the type of legal entity for the proposed JV? What are the implications of the choice? Well, for example, if you want to issue later on a debt instrument, like bonds, right? Can the bonds be issued by limited liability company? Then you look at issuance of debentures permitted according to the procedure prescribed in the KCC. yuan as a not permitted. yuan 책임 as a not permitted. Okay? So if you have to issue that instrument and get financing through that instrument, then limited liability company is not appropriate. Right? So you have to know these things in order for the proper valuation to be done. And that has to be decided, within the parameters of your proposed business. What will be the constitutional document and the basic corporate governance framework for the JV? What will be the constitutional document? It's like a constitution. It is like a constitution, the very basic document that sets out the basic rules of how this company should operate, and that is called what?
Articles of Incorporation. Articles of Incorporation.
Yeah, that's Articles of Incorporation. All right. So Articles of Incorporation in Korea usually is a kind of mixture. If you look at the United States, you have something like AOI and bylaws, right?
Sorry. May I ask you something?
Yeah.
What's the difference between an AOI and a memorandum?
It's similar. Sometimes they call it Memorandum of Incorporation. Sometimes they call it Articles of Incorporation. Sometimes they call by Articles of Association. Usually in British, in those countries, they use Articles of Association different. In the United States, for example, you have this AOI and you got bylaws, right? AOI sets forth more fundamental things about shares and things of that sort. But bylaws provides more detailed provision of, what items need board resolution and how board resolution should be taken and things of that sort. However, the Korean Articles of Incorporation usually combine these two, right? And it has a certain thing. It has, name. If you look at the KCC, there are a number of mandatory items that needs to go into articles. Okay? Other things are optional. Right? You don't need to say how the minutes should be held. Those things are not needed. If you look at the Korean Commercial Code, the name, okay, of the company, the authorized shares and things of that sort, there are those few items that needs to go, but the usual form is that not only we have those things, place of business, and things of that sort. We got like shareholders, we got board of directors, representative director, and statutory auditor. Then about the fiscal year thingy, and in those matters, you go through that. I mean, you can get a typical form that is used by searching the internet, and there's a type of forms that are available. But that information is available. Anyway, that's articles. And the basic corporate governance framework. What's the highest decision-making authority for a corporation, for a joint stock company? Highest decision-making. Is it a shareholders? Is it a board of directors? Or is it a representative director? And obviously, it's the shareholders, okay? What the shareholders do, they, it's a shareholders. They invest in the company, right? The shareholders are here. They decide most fundamental things, okay? What is the fundamental thing? How to manage. How do you do that? They appoint directors. And to make sure that directors are carrying out their duties, they appoint statutory auditors. Right? Then they appoint the most fundamental corporate changes like liquidation, if you want to be dissolved, or if you want to go through merger or sale of all assets, things of that sort, Or if you want to change the articles which sets out the business purpose and you want to change that, then you need the shareholders, okay? If you want to create new type of classes of shares, you need this, right? So that's why the shareholders are at the top. But the management of a corporation is run by the board of directors, BOD. Okay. And then BOD elect what is called the representative director, 대표이사. And this 대표이사, representative director, does the day-to-day kind of a management. And then, but the ultimate responsibility lies with BOD. So important matters, they will decide what to do. And then there are matters that need a shareholder approval, and obviously they will convene a meeting and then get the required shareholder approval. So that's how the system goes, right? So obviously, if you, for example, you can manage through if there are two shareholders in joint venture, then you want to select probably equal number of directors for this board to manage, right? Right? And then there is an appointment of representative director. Who's going to appoint that? Which shareholder? There's a domestic party, the Korean party, and the foreign party. Okay? So who is going to represent? Who is going to appoint, nominate the representative director? That's an issue, right? So I told you, I think I probably told you before, that usually, can you have more than one representative director? Yes, you can, right? You can have as many as you want. You can have more representative director, more than one, okay? Let's say if you have two representative director, you have two RDs, okay? But they can each one what is an RD? What is an RD? What is 대표? What does that mean? What can he do? Or what can she do? Yeah.
Can act on behalf of the company?
Exactly. I mean, he is the legal representative, right? He can enter into a binding agreement. If he signs it, the corporation is, in most cases, are bound. need to carry. Even if he didn't, even if he needed a board of directors approval for that, if he goes and sign, right, with another party, and another party does not know this requirement, and expects this to be bound, it's a good faith bona fide kind of a party, then you are bound, right? For example, if he signs it, that's it. But he can. But if somebody else, then representative director signs a contract, right? What does the other party say? Hey, do you have the authority to sign this contract? That's what they ask. And how does he get an authority to sign the contract? Usually, the simplest way is that since this is the representative director has the legal authority, he can just, through the power of attorney, delegate that. He's just signing on my behalf, right? Or the BOD can appoint him, obviously. All these are represented, elected by the board, anyway, okay? So if you have two RD, they can be several, meaning that each one can just represent, they can act separately, okay? If this RDA and RDB, A goes and sign a contract, and that's it. Or B can go and sign a contract, and yes, it's a binding contract that binds the company. If you have something called joint representative director, 공동대표, right? Right? Joint means in order to bind, you need not only A, but you need the signature of A and B, right? That's a joint representative director system. How does the other party know whether this is a joint representative director system or just one party system? How does he know? Well, that is why if you have the joint representative director, you have in the commercial registry extract, okay, 등기부등본, right? So if you get the 등기부등본 of this company, right, it gives you certain information. Have you ever seen a 등기부등본? Right? Okay, well, it's easy. You can even check out any 등기부등본 if you know the name of the company. You can go. Yeah, it's a public document.
Is it the power of attorney? Something like that? Power of attorney?
No, it's not power of attorney. It's a commercial registry extract. Means it gives you. Every company needs to be registered with the commercial registry office, which of the court, right? And then it gives you a public information about the company. It gives you the name of that company, legal name, and the next is the registered location of that company. And then it gives you how many shares out, how many authorized shares, number of authorized shares, and actually the number of actual shares issued. So it gives you paid in capital. And then it states the purposes that are stated in the article, business purposes.
Actually, in France and Spain, there is something similar. We call that act of constitution, something like that.
Okay, but this is what the commercial registry extract. And then the next section, they give you who the directors are. Okay, they give you the name of the director and its terms, and who are representative directors, right? And then there's who is the statutory auditor, basically. So these are the information that is contained in the commercial registry extract. For any company, you need to check. You need to check this. And if it's RD system, if it's a joint representative director system, then it should be stated here as a joint representative. Okay? So think about it. If you appoint the directors, let's say 2 people from here and 2 people from this side, they all need to be registered. Here, their names and the terms. And one of them, if you got 4, one of them, or more than one, has to be an RD. Has to be a representative director. So that is the scale of how this works. Okay? So you got the shareholders, then you got the board of directors, and then the daily management is done by the representative director. The directors are appointed by the shareholders at a shareholders meeting. Does it require a special resolution or ordinary resolution? Ordinary resolution for appointment. But if you want to dismiss a director, you need a special resolution. Okay, so all these things are in the commercial code. Okay. Then the next question is that does it need to state its purpose of incorporation or business scope in the constitutional document? Yeah. Articles of incorporation has to state the business purpose. Usually, if you look at the Articles of Incorporation of the United States, it usually states, instead of doing A and B and like import business, manufacturing, and all those things, it just states any businesses that it can legally permit it to do. You just have a one simple, right? One simple line. But instead, Korea still has this law that says that articles must state its business purposes. Does that mean, next question is why? Does that mean a company, unless its business is stated in the articles, it cannot engage in other businesses? So that's the ultra vires question, right? Ultra vires, or however you pronounce it. Okay? It used to be in United States too. The company states its business purpose because any business that it conducts beyond, okay, their purpose is not recognized. It's beyond power. Okay? Ultra vires means beyond power. Alright? Beyond its allowed power, so it's invalid. Right? The shareholders can come in and say, what's going on in here? Hey, this is not the thing that you are allowed to do, management. What have you done? And then through shareholders' derivative suit, cancel. Okay? And if there's any damages incurred by the company, then, you can go after the directors who have permitted to do that. Right? So, is there a legal concept of corporate ultra vires under Korean law? Here, I think the general question is there's no strict ultra vires doctrine because the trend is just, you are permitted to do anything that you can legally do. And I understand, though I'm not a Korean lawyer, but I understand that Korean court have held that purposes stated in the articles should not be limited, okay, should not be interpreted as the limited legitimate conduct, okay? However, since there is no clear cut, like court cases on this thing, it's still, as a lawyer, we recommend that if you change your practice, you should update your articles. You should change and update your articles, even though it happens afterwards, right? Because for example, if it's a big company, it's difficult to actually convene a shareholders meeting. right? If it's a small company, then it might be easier. But for big company, it's difficult. Because in order to pass and change the articles, right? You have to wait for your annual meeting, perhaps. Because if you want to do it in before, then you have to get enough people interested to be present. Because the article, in order to amend the articles, it's what? It's a special resolution. Supermajority is required, which is whoever that is present at the meeting, you have to get 2/3 of whoever present, and whoever that votes for it has to be 1/3. Okay, of the total issued and outstanding.